years focused on infrastructure transactions, and I have been focusing my practice on digital infrastructure M&A for about 10 years. The next panel will focus on what is next for digital infrastructure M&A, and the challenge to getting deal done in light of the current market conditions. We have a very diverse panel with individuals from different jurisdictions that will allow us to hear different perspectives to this topic. So why don't we start with a quick introductions from each one of you. Heather, if you wouldn't mind.
Sure, thank you. We have the challenge of trying to keep everyone awake. I think I heard this was the last panel, so we'll do our best. I'm Heather Paduck. I'm the CFO with Stack Americas. Just a little bit about Stack. We are a global data center operator and developer. We've got platforms in the Americas, which right now covers the US and Canada. We're in EMEA and then in APAC as well.
Afternoon all. My name's Matt Barker. I'm a managing director at GI Partners. GI Partners is a North American headquartered investment fund. We're currently investing in a data infrastructure fund and have 6 platform investments in that fund, 3 in the data transport space, 2 in data storage, and an IoT business called Walcom.
Good afternoon all. Antoine Le Pagno. I am at Santander Corporate Investment Banking. I run our digital infrastructure M&A delivery franchise. I've been in the industry for the past 20 years. 3 quarters at a large public market bank focusing on telecoms, but now focusing for the past few years on digital infra.
Good afternoon, I'm Derek Neal. I'm a partner at BDO. We're a global accountancy, tax and advisory business, and my world is transactions. We provide financial, tax, commercial, operational, all the sorts of due diligence you'd expect. And my challenge today is I have hay fever, and it turns out my pocket square is fake.
Thank you, everyone. Matt, why don't we start with you? What has been the focus of your LPs in light of current market conditions, and are you seeing a lot of pushback in deploying capital?
Yeah, I think, I mean, just sitting in on the panel earlier, I mean, it's clearly a very sort of positive environment operationally for the sector that we're operating in. And you've got a number of tailwinds, and arguably those tailwinds are just getting stronger and stronger for the sector itself. What we're seeing is that is balanced against the more general macroeconomic conditions, actually, and when we're speaking to our underlying investors in our funds, actually it's quite a tough environment. So they are seeing the valuations of their public portfolios come down, and when they then look across their underlying asset base, that sort of makes them relatively overweight to private markets. And so we're starting to see that sort of conversation come through. Now clearly that then has a lag effect on funds raised, because you've got a number of platforms, and in fact over the past few years there's been lots of capital raised focusing in on digital infrastructure. But we are seeing that sort of near-term sort of, whether it's a concern, it is certainly an impact of the general macroeconomic environments coming off.
And you touch upon capital raise, the Stack infrastructure has been successful. We keep raising that, in particular over the past couple of months. Recently have been raising $250 million financing for data center expansion. How does the current market and the challenge in raising capital is influencing your perspective and your approach towards organic growth, inorganic growth, M&A, developments in-house?
Sure. I think we're seeing pressure in 2 areas, maybe stating the obvious, but cap rates continue to widen, and that has an impact on our theoretical leverage. That's one. The other is on a rising rate environment, which has multiple impacts, but obviously increases our debt service coverage. To offset this, and I think we've been successful in doing it, although it is challenging when you're up against these large hyperscalers who often extract a pound of flesh when you're negotiating a lease. We've been able to maintain or increase our development yields, and so that's helped offset the pressure we're seeing in capital markets. I think the other thing I would say is we've been conservative in terms of our interest rate policy. We fixed all of our debt. Fortunately, a lot of that debt was fixed a number of years ago, but we do have a blended lower interest rate because of that. I think the last thing, this was touched on in one of the earlier panels, and it's probably something that keeps me up at night, which is just access to capital. As you think about, and maybe my lens is I think it's global, but my focus is in the US, and I think as I think about the capital markets. In the US, we've got the ABS securitization market, and that's been very beneficial for us. But I think to be successful and to continue to have access to multiple pockets of capital, and in particular, as we think about project financing and when we put that in place to develop our greenfields, those lenders are looking for you to have an exit strategy, not in terms of the asset, but in terms of refinancing. And so having that platform and the ability to do it, and it starts with having really good underlying credit quality of the customer base and you know, the income for the asset. So for us, it's I worry about our ability to continue to attract capital. In particular, you talked about the overweight of this asset class, or real estate assets in particular, and some of the other things that I worry about is adjacent industries within real estate, things like the wall of CMBS debt that's coming due, and I think about that has to be refinanced somewhere. And some traditional capital sources, I think, will be left upside down, and therefore maybe need to sit on the sidelines. And so the more that we can do, I think, to educate, and investors are getting more educated. When I think about, we do roadshows every time we go out and raise a new tranche of ABS debt. We're in our 6th fundraise right now for that. And the level of investor awareness went from, we were doing investor 101 conversations to now 301, right? So they understand the stickiness of the sector, they understand the asset class, they're getting more and more educated. Also means they're asking harder questions, but I think the more that we can educate, the better we're gonna be to be able to make sure we've got that capital there.
And Anton, the industry has proven to be very resilient, right, throughout the pandemic, has attracted a lot of interest from different investors, which has, of course, driven valuations through the roof, right? Valuation expectations have been super high. This has been a very kind of seller-friendly market. Do you expect the current conditions to reshape that a little bit, bring valuations expectations down, and where do you see the new opportunities coming up in light of all the turmoil?
Yeah, regular question, I would say. Look, pandemic just proved the sector to be critical. It got a lot of people much more excited on the space. It acted a bit as a wake-up call for those who were not aware of the criticality of the sector. And indeed, more money coming in and valuation going up. I think the real resilience test is happening right now, as we speak. So to your question on repricing, the short answer is yes, obviously, if you discount the saving of cash flow by a denominator that increases because debt has increased, of course, the value is down. That was the response and a quick assessment from public equity markets, which I think it was January last year, a month before the war in Ukraine. The first real fears of rates going up drove listed company stock down by 20% in 2 to 3 weeks without any corporate news or without any bad news on the operating side. Okay, and so that was the immediate response. And that's a fair one because, you know, as interest rates go up, the cash flow will go down, cash flow to equity will go down over time, so that's a simplistic response. Now, if you take more of a, call it, long-term perspective, and I think a lot of people in the room are doing so, long-term investors, and we're talking about infrastructure, so long-term assets, then it gets much more complicated in my view. First, not all assets are equal, that's for sure, and I think that's proven every day when we see transactions happening or pausing. So that's one thing. If anything, in the past 12 months, all the situations I've been involved in have changed, have become more complicated, there's been pause, there's been reshaping of perimeters, there's been change in the timing, delays, and clearly there's just more work going into assessing investment opportunity, and that's sound to some extent. I think people, what investors are doing now, and now looking at business plan, trying to tweak them. Is it possible to delay capex, or is it going to be a loss if we delay capex because it's a loss of opportunity? Is it possible to I don't know, change a bit the cost structure, amend the developments? So there's just much more work going into the field, and I think that's a fair thing. And in fine, the assets that sort of survive that more strict framework in terms of valuation do get high valuation, and we've seen deals announced with high value and premium multiple very much in line with multiples from, call it, boom time. So there is that differentiation, increasing differentiation happening. So if you tell me advising a seller now, it's clearly not the time to sell a good asset that's not just great. So you're not going to get premium multiple for an asset that's just good. Okay? At the same time, you don't see buyers getting bargain deals either. Okay, there's no forced sellers, no real bargain, just expose, there is other ways of alternatives. So our feeling is that the music is still playing, okay, but the partition is clearly more complex and just more work getting into to cross lines. So in terms of opportunity from there, I've had very frank conversation with a number of investors who are, and I think the key thing to identify opportunities is really know who you are, what do you seek, what type of return are you looking for, what is the limit you cannot cross, and what is the flexibility you can get. Because right now, a number of people are considering selling, but then they have in mind these high multiples, but maybe they could be open to new solutions, maybe it's partnering, maybe it's coming up with a new layer of capital structure. I think, as I mentioned, more sophistication around the investor side and maybe more pockets of capital coming in to help. And I think this kind of solution, we're obviously trying to grow these kind of solutions every day, but that helps. So the more agile you are, the more opportunity you create for yourself. Curiosity is also, I think that I mentioned this morning as a key quality, but what we're seeing also is since there's probably less of a flurry of deals coming up to market, there's a bit more time to try and reflect, and we're seeing some investors taking a broader view and trying to reconstruct or deconstruct value chain and try and find new opportunities inside what is what were very sort of stable, again, the one fiber or data centers. You've got sort of the three basics, and inside that ecosystem you have sort of new business model appearing, and that can be of value for a number of investors chasing higher return by taking a bit more risk. So I understand all the concern, risk, and fears, but at the same time I still see capital available. Okay, it takes longer, it's more difficult, there's more scrutiny, but the long-term trends are still supportive, and so very optimistic actually about the next few years in terms of investment and assets rotating inside the ecosystem.
And with so much competition for assets, Derek, are you seeing your clients trying to diversify a little bit more, being a little bit more creative as to what would fall within the mandate for digital infrastructure?
To some extent, and I think people have always had a look at adjacencies, but still the vast majority of the money, billions, is going into the usual assets, fiber, multiples going into data centers and towers. So there is, you've heard from Heather, there's plenty of demand for capital in what you might call the usual assets, but then there are also some demand side drivers that mean people are looking elsewhere. So subsea cables, for example, that were laid in the 90s, there is a replacement issue there as well as a capacity issue. We're also seeing more investment in satellite communications because the cost of launching a satellite has just come down and down and down. Richard Branson might not agree. And then perhaps the area that I'm seeing lots of interest, but I don't think people have quite cracked it, is around street furniture and monetizing the opportunity to put 5G cells into bus stops and that sort of thing. So it's around the edges, but I still don't think it's where the majority of the action is.
And then probably a question for both Anton and Derek, given kind of your advisory side of the house here. What are the key challenges for a new entrant in these markets, right? Whether they be in Europe or in the US, what do you see as playing a significant role in investors deciding to pull the trigger?
I would echo a lot of what Antoine said, that you're having to pay up for things, and so in that sort of environment, then you need to do your diligence. Now I would say that, wouldn't I? But I think that's also what we're seeing. It's challenging. The bar is high now because of the multiples that are being paid, and then you overlay what we heard about in the last panel around some of the ESG requirements. All needs to be considered. It's a challenging regulatory environment, so you're looking at whether there's perhaps Chinese equipment being embedded in what you're using technically. So there just feels like there is a higher hurdle, more to be done to successfully complete deals.
If I may, I have a few remarks to that. Totally agree. There's probably another dimension if you consider some sort of new entrant, and if you try to look at Europe, and as we said earlier this morning, I think that that industry was led or had been driven out of the US initially. Going into Europe, the global thesis is valid, but then each country is different and each location is different. So when it comes to DC, we go, flat D market. That's already a vision whereby, the EU was sort of united and we're talking cities by cities. I think on the fiber space of telco space, it's really country by country, with its own regulation, its own regulator, etc. It's already a country story on the DC side. It's not yet. I think it may come at some point, and I echo the concern of this morning for more regulatory scrutiny coming, that's for sure. So the only advice for someone who wants to sort of enter new markets is really get in touch with the locals, environment, the people, the administration, the understanding the politics around it as well. That's critical. One option is to obviously partner with a local investor when possible. It's very common in France to have a sort of a French flag in a mix, but it's something that works because you sort of gain time in terms of getting to know the market you're investing in. So that's important. And I mean, if anything, it goes against the sort of work ethics. So prepare. There's no other advice to someone who actually wants to get in the market just to avoid surprises. The best thing remains to rely on as many advice as possible, and obviously spend proper time and get the right people next to you to assess the opportunity. So it's difficult. It's probably easier sometimes to invest when you have your own track record in a place, especially when assets are critical, and they are critical. And they will become more scrutinized for sure. Again, DC space has been a bit safe from some of that front, but I can clearly see politics getting more cautious or more, they will apply more scrutiny to those transactions for sure. So again, preparation and understanding of the ecosystem across many stakeholders will be even more critical in the future.
And with all this backdrop, right, kind of not being easy to find the good assets, lots of competition, how can you be creative to just getting deals done, right? I mean, deals are getting larger and larger. The good assets are just not that many. So how can you be creative in terms of trying to get deals done?
Just maybe just adding to the earlier points as well, which I think links neatly. I think the thoughtfulness around transactions and investments and businesses fundamentally doesn't just stop from an investor perspective at the point of transaction as well. I think it will be increasingly important for all of us investors to be thinking through what is the plan for this business over whatever the period might be, whether it's 5 years, whether it's longer term. And I do genuinely believe, I think, over the next cycle, more value creation is going to come from your traditional operational improvement, growth, agreeing with the management team that this is the strategic plan for the business, as opposed to, as investors, we've been fortunate in that actually the inflows of capital have reduced sort of return rates, and that's benefited valuations. I think it's going to be a tougher time for investors over the next period, because it's going to, value creation is going to be actually getting down there, aligning with the team and backing them to deliver on a plan. That said, I think, yes, the transactions have been getting larger. I think we've also seen sort of pools of capital getting larger as well. And I think many investors that, if you rewound 5-10 years, would be mid-market, small mid-market investors. Actually, a number of those have increased fund sizes. So I think that the capital checks have tended to follow the transaction size as well. What you do see is more investors teaming up and an increasing willingness to team up as well. We've certainly considered it when we've been, I mentioned earlier, we're a North American fund. I'm sort of setting up our European presence, and as we're looking in Europe, I think finding local partners is certainly something that we're considering. And sort of blending our sort of sector experience with the local knowledge is absolutely something that we'll look at. One of the other, it's often a nice problem to have, but as a mid-market investor, as we are, if a business goes well, you might get to a point where it's starting to become too large for the scale of investment that we would feel comfortable holding. So there your options are, do you sell the business to a larger investor, or do you bring in partners as well? And I think that's another feature that we're going to see. When businesses perform well, I think you'll see investors looking to bring in partners alongside them, and they may be your traditional LP co-invests, but they may also be other active managers as well who can bring their own slant on the value creation. And I think investors are increasingly recognising that that's a viable option too. The flip side of that equation is that you see, as Antoine alluded to earlier, you see delays to exits as well. So there's also the continuation fund, because actually now is not the right time to exit, and then so investors are looking, or funds are looking to buy time until it is the right time to exit, which is also something that I suspect we'll start to see more and more of.
I think another tool that investors are using is doing a hell of a lot of hard work before the process even starts. So by the time the advisors are going into market with the IM, then the investors coming saying, I've already done X, Y, Z, I'm good to go, because deliverability in an uncertain world, then that's kind of critical.
And how do you can do this kind of pre-preparation for deals, right? I mean, earlier conversations with lenders, and we've been seeing lenders having much more scrutiny on deals, being very picky on diligence. How do you prepare yourselves for that?
Yeah, there's certainly a lot of scrutiny. We're getting more and more questions. I think that the biggest focus is around timeline and cost. Can you deliver what you're legally obligated to under your lease? With very few outs, right? What actually falls into a force majeure clause that allows you to get out at the end if the power's not there, if the project doesn't get entitled. And so maybe I'll take it from just touching on their angles in terms of, as I think about it from the lens of an operator, and the value chain that we provide to our investor being, we're sort of along for the ride every step of the way, and where we provide expertise not only for our investors, but what we're seeing and why we see some of the hyperscalers who are shifting more to third parties like ourselves rather than self-perform, because they don't necessarily always have the expertise, the local knowledge, is dealing with the utilities that we've built up relationships in all of our key markets that has become critical for us. When we call and if they pick up the phone, there's not a guarantee, there's always power on the end, but we're starting to see earlier when there are signs of trouble, right? And Northern Virginia has been in the headlines as power troubles and no surprise on Dominion. We're starting to see it in a lot of other markets, Silicon Valley, Hillsborough, Phoenix, right? There's rumblings of power issues. And so when you've got that local relationship and you can figure out and have figured out entitlements and planning, that's a huge value add. And I think following that all the way through, then constructing, and then we in-source operating. And so that whole value proposition that I think makes it really hard, it makes platforms that much more valuable, and probably why you continue to see EBITDA multiples at mid-20s to 30s, because the price of admission and getting in and getting a team that can operate is really challenging. Ideally, that comes with some sort of a form of a land bank. But that's why I think it's interesting that the interplay between multiples that have remained way more resilient than cap rates, I think, for that reason. To your original question, I think, around what lenders are focusing on and how we prepare. So it's all things around cost. So, power procurement, obviously, and the unknown cost there, we often have very large contingencies in our business plans because the utilities can't commit to what's it going to cost to deliver the infrastructure to build a substation on our land. And so that's a big one. The other one is you think about supply chain issues everyone is dealing with, and it impacts the delivery of our projects. And so, which also leads to cost increases, right? So their focus is on inflation. How are you underwriting for the inflation unknown for a project that you lease today that you don't deliver for 3 years? And what is your inflation contingency there? How have you thought about it? And so that's really, I think, the biggest level of scrutiny that we get. And we're finding, not to harp on power, but going back to it, there's often utilities where you don't necessarily have a written agreement with a promise that the power will be there and they'll deliver. It's oftentimes, yeah, we've got it, it'll come, it'll be there. But there's no contractual arrangement, at least not in all of our markets. And so getting a lender comfortable with that, that's a whole nother dynamic that has been really challenging.
And how do you see your clients getting themselves comfortable with all of this, right? Do you see folks going kind of back to basics on diligence, stopping, kind of taking a pause and say, hey, this is what we'll do, check all the boxes?
There's certainly a good deal of that. I think diligence goes in cycles, and perhaps not so long ago, then it was based on a bit of PowerPoint and a business plan, and now there's a hell of a lot more to it. So I think it is about scrutinising the assets much more carefully, which is why I think you've seen the proliferation of some really technical consultancies who are looking at these things in quite a lot of detail. There's much more consideration of the people now, and as you're starting to create these opportunities to maybe split the property from the operating business, then a hell of a lot of work also going into how you might be able to carve out these things. It is just a more challenging environment.
And then how do you see new opportunities coming up in light of all that? So you see, for example, lots of infra-core, service-core splits. Why do you see the next wave of M&A coming up over the next 12 to 18 months? Jonathan, sorry.
Yeah. Now, this one, that's one of the core. It's been one of the core drivers more on the tower side, but so infra-core, service-core for telcos, that's obvious. They have a capital structure problem to solve, so that's been an obvious one. Telco is at 6 times, infra is at 20, so it's fairly simple and obvious. So we'll see more of that for sure. Although all the reflection around the value of infrastructure, the particular role in sort of mission statement or what telco needs to deliver, has prompted a number of them, especially those who don't need or are not for seller, to re-engage and reflect on what is they're going to do with the infrastructure. They're still stuck in terms of capital structure valuation. The problem is not solved, but there is much more reflection going into this. So I would see more infrastructure going away from service, and that's sort of normal. And the lodging industry has seen that in the US 20 years ago, so it's sort of a natural trend. But probably more careful now than before. And I would not be surprised to see the infrastructure portion of it increasingly split, or that's a question we've seen around co-appearing now, so sort of deconstructing the value chain. At the same time, you have an argument saying, DC goes with fiber connectivity as well, so some investors could take a play that actually the right perimeter might be gathering some of the assets together in some countries or some location. Maybe it's relevant, not everywhere. There are the people who made the bet of being full infra-core, being tower and fiber networks all together, saying I'm going to be the player that offers the route to any communication. So all those sort of new segments are being tested, and so that's very interesting, very exciting, and that, if anything, will increase opportunities for assets to trade or strategies to be followed. And I'm not sure there's a one winning strategy, because each country or each location or region has sort of different needs. The sort of industry in the north of Italy is very different to the way it's set up in the US or to the way it's set up in south of Spain. And so those companies don't have the same needs, and hence the solution may not be identical across the continent.
We are coming up on time.